Have you ever played hide and seek, and just when you think you've found the perfect hiding spot, the seeker goes straight there and catches you first? That's exactly how stops hunting feels in trading. You think you're safe, but the market knows where you're hiding. So, what is a stop hunting? In simple words, stop hunting is when the market deliberately pushes price to a level where many traders have placed their stop loss orders, knocks them out of their trades, and then reverses in the opposite direction. Why does this matter? Because big players, banks, institutions, and smart money need liquidity. They need the other side of the trade to fill their large orders. And where is liquidity hunting? At the exact spots where retail traders place their stops, under obvious support, above clear resistance. Those levels are magnets for stop hunts. Think of it like a fisherman throwing a net. He doesn't chase one fish randomly, he casts his net where the most fish are gathered. For big players, retail stop losses are those fish. By pushing price just far enough to trigger them, they get the liquidity they need. Let's make it concrete. Imagine EURUSD has strong support at 1.0800. Thousands of retail traders place their stops just below at 1.0790. Price slowly drifts down, taps 1.0788, wipes out all those stops, and then shoots back up to 1.0850. That wasn't a random move, that was a stop hunt. Everyday life gives us examples too. Think of a store on Black Friday. People line up hours before, and when the doors finally open, the crowd surged forward. The store knew exactly where the crowd would be and used it. In the market, smart money knows exactly where the stops are, clustered, and targets them with precision. Now, why is this so dangerous for beginners? Because most beginners are taught to place stops just under support or just above the resistance. It feels logical, but if everyone does it, those areas become obvious traps. The market knows, and that's why stop hunts happen so often. So, how can you avoid being hunted? First, stop placing your orders in the most obvious places. Instead of putting your stop directly under support, give it a little extra room, beyond the zone, not inside it. Second, learn to read liquidity. If you see price building up at a level with many rejections, you can bet that stops are piling up there too. Expect a potential stop hunt before the real move. Third, combine stops with confluence. Don't just rely in one line. Use higher time frames, levels, structures, or tools like order blocks and fair value gaps to give your stops a stronger protection. Show charts with support zone, plus confidence with trend line and fair value gap. Confluence equals safer zones. Here's another example with numbers. As stock traders between 50 and 64 weeks, retail traders put stops at 49.90 and 60.10. The stock dips to 49.80, triggers all the stops, then rockets to 55. Later, it pokes to 60.20, triggers more stops, then drops to 54. Both sides were hunted before the real move. Psychologically, stop hunts are brutal. Traders feel cheated. But the truth is, stop hunts are not accidents, they are strategies. The market uses them to gather orders, reset sentiment, and prepare for a real move. To recap, stop hunting is when the market deliberately pushes to areas where stops are clustered, triggers them, and then reverses. It happens because big players need liquidity. It often occurs around obvious support and resistance, and the way to defend yourself is by placing smart stops, looking for liquidity pools, and being patient enough to let the trap play out before you act. So, in short, Stop hunting is the market's way of clearing the table before serving the main course. If you learn to recognize where stops are hiding, you won't just avoid being hunted, you can even take advantage of the trap by trading in the direction of the real move once the stops are gone.